Further signs of a shrinking economy were evident in the June factory output reports for both the Eurozone and Germany. Each report showed its fastest decline in 3 years. Barclays chairman stepped down this morning after the bank accepted responsibility for an interest rate price fixing scandal last week. I'm Lindsay Bell, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsay Bell with The Street, and together we bring you the morning call. Manufacturing data from Europe to China has slowed, we learned this morning, but the market doesn't seem to care here. We're setting up for a flat open.
Yeah, I think the futures are a bit positive, and a lot of the news that came out over the weekend is pretty much the reason why, I guess, finally on the 19th European Summit, they finally did something a bit more substantial than they've done. So I think all the news that keeps coming in, as negative as it is, until the market wants to focus on it, is being discounted, and that's why you're seeing some follow-through to Friday's very potent upside action, which also coincidentally was lined up with the end of the quarter that wound up giving the portfolio managers some nice finishing touches on their percentage winners.
So what are the levels you're looking at today on the S&P going into trading?
Well, let's take first a short-term, then a longer-term look. And if you look at the short-term levels on the SPX, you will see that technically, if you put all the hoopla on the side, we acted pretty well. You know, if you recall this inverted head and shoulders pattern we talked about, with this being the left shoulder, the head, the right shoulder. First move we did from the neckline right here, we talked about the depth of about 30 handles. That took us up to about 1360. And if you remember that, we talked about selling some into that, which was a retest of this little breakdown point, and it was a short-term sell, so I would say signal, target, whatever. PS, we came down, we retested this 1309, we held it a few days in a row. If you want to take a closer look there, you will see that, you know, even though it felt like the world was falling apart here, we still held that support. If you look at your Fibonacci retracement, we talked many times that if we held at least the 61.8% retracement, that the rally can still be on if we get any kind of good news. And if you look here, we did hold that level, a level we held many times over the past few years. And if you take this out of the way, you will see, once again, you had this little inside range. You put Friday's news there, you put end of the quarter there, you put some little shenanigans there, and pow. Big move up. If you're short, you're scared. You know, if you need to get long, you had to act quick. And now we're right back at this really big level here. We're opening probably a little bit above it. So this 1363 area was the area of resistance. So if we don't pull back at all, I think some of these shorts are trapped. The next level could come quick, especially in a holiday shortened week ahead of a jobs number. Here's your 1388. There's a little minor point here at around 1373. So I think short term, early this week, we could probably hit this area. Use Friday's high as your pivot just in case they want to open up and do a little probing here. But here's higher support around 1350, 1354, 1363, 1373. And then this is the entire measured move of this short-term pattern that takes you right up to about 1390 after this nice pause into Fed day.
How about a longer-term version? Because for the second quarter, the S&P is down about 3%. But for the year, we're still in positive territory. So how do you set up for the second half of the year?
I think positive territory is like an understatement, because if you remember, it feels like it was like years ago, the first quarter, we had a powerful move. We were up over double digits in many of the indices. So coming into the second quarter, we're like, you know what, let's switch gears. First quarter, we went from holding like 10 to 15 positions, massaging them. So as an intermediate trend trader, you almost felt like a macro holder. That was the first time in a while that I was able to hold that many positions for that long. If you take a quick look at the weekly chart, we'll go to the S&P. You know, you'll see that overall, and I'm sorry I drew all those lines. You know, we've been following a really nice trend, even from, you know, the 2009 lows. You have a high, you have the low here, you have a higher low, another higher low. So this trend has been continuing. If you want to take even a closer look from when we bottomed back in December, you remember that little low that we talked about, or actually in October, we'll go to this weekly chart. You will see that, you know, overall, you go to this Fibonacci retracement from the October low all the way to these highs on a macro level. You only pulled back about 50%. So from this October low all the way to the recent highs of this year, you only pulled back 50%, which is even stronger than the short-term trend we just showed that went all the way back to the 0.618. So overall, the trends are intact, and you just have to know what your price frame is or your time frame is. Because if you trade over trade, you might get out of your positions and miss a day like we had on Friday. So have a macro equity strategy, but then also learn the way you're learning by watching this to make some money on the intermediate trends using your tier system.
The whole market had a great day on Friday, actually, but the Nasdaq was up the most in all of this year, was up about 3%. So we're going to take a look at some tech stocks. We'll look at bellwether Apple first. This was definitely a tradable name on Friday. It opened up 7, but ended up 15.
Exactly. So, for me, I watch Apple, and the last few days of last week, it's okay if you were a little light because Apple did show a little bit of weakness. Some of the leading stocks were not acting well, but they never violated any of their macro points. So on an intermediate basis, maybe you could have made some cute money both ways, but overall, if you take a quick look at Apple, you will see that it's still above the 100-day. It's well above the 200-day. It's got this tight little chart pattern here. If you didn't come in on Friday and you were trading and you wanted to get involved, it was up 7, closed up 15. You do have this resistance in front of it that you could see, so it has some freedom. If it wants to trade through 584, which is Friday's high, next big level comes in around 590. We have earnings coming soon. So overall, on a macro basis, stock still acts very, very well. Intermediate, it's been very, very, very choppy, but there's been some short-term cash flow in there. At this point, I think it's back to glass half full on a short-term basis. Next real level here is around 589, 590. I'm not sure if it'll see it before earnings, but know that level when we get close to earnings, but we'll see.
Facebook was one that had relative weakness compared to the group. They were actually negative on the day slightly. So what's the trade here?
I think you had two trades. You had the reversal, the red dog reversal, which we call it. Then when it broke the downtrend, when it went above 28.10. And then I think some of the air was let out of the bag when all the underwriters came out and they weren't really that overly enthusiastic, which is probably okay. Because if you think about it, it has a high valuation, has a lot to prove. It has to have earnings come out. You have a few lockups it has to deal with. So for now, short term, you look at the chart, you will see that you had this short-term red dog reversal right here, which was a nice little entry. Okay, and then you had another nice entry we talked about right around this 28.10. And then this was going into the end of the quiet period. And right now, it's trying to hold this area. It's trying to hold this 30.90. I do think short-term tactical traders, if you see relative weakness like today and it starts breaking, they're going to try and short it. So then I would say the level underneath this is about 30.10. And then, maybe it wants to come retest this area. So at this point, I would say, if you're in it from here to here, hopefully you protected some. It did break this also. Off the charts, we had this small little ascending channel for short-term traders. I think it was Thursday I made some money short this. And at this point, so here's your defined support. But I think overall, the next dip here will be buyable. Just a question of whether it's 30.10 or a retest of 28.10.
Amazon's been a strong stock since mid-April when it had that earnings gap up. But can it maintain the uptrend?
At this point it is. And even like Apple, it was a little faulty last week, but rightly so. A lot of people thought the market wasn't going to hold in there, so the leaders started playing catch up. That's why when you get that bid, it's fast and furious to the upside. So overall, if you look at the chart here, a few different entries. Here was that earnings gap. It then corrected and consolidated. Here was that wide range bar that could have got you back in. And ever since that day, it never really violated it. So if you entered on this day, which was a day we spoke about, it was a very important engulfing day, it never came back and went below it. It never even gave back more than half of it. So that was one entry. And then when it broke above this descending channel, here was another. Yes, it came in and definitely tested you a little bit right here last week like it tested most longs, but overall, it's working higher. You have this pivot high up here. We have earnings coming out. So it's really going to be all about earnings. But this one, as of right now, is acting much better. If you're an investor, you haven't been through the ringer like some other sectors, other stocks, and you have this peak and then this one at this point, it's been very tradable.
How about Google? That one passed its 20-day moving average on Friday, but it's still down 10% for the year. So I'm not sure if it's buyable here or we need to maybe wait to get through earnings on this one.
This one's been a different story than Apple and Amazon. If you bought it earlier this year, you're not making money yet. You could have bought Apple, you could have bought Amazon so many different times and made money. Here you had to be so selective. Each time we got to earnings, it wound up being a disappointment. But on a macro basis, it never broke below that 560 or 555. It looked like it was, and I even tried shorting it a few times last week, and I covered and I didn't fight it. But overall now, if you look at the chart again, you'll see that it's holding this long-term, area. This was the low back here. When was this? This was back in November 25th. Here's a low. So it held here by a thread. You know, I know Spider-Man was coming out. Maybe he spun his little spidey web down there. It was very, very strong. So PS, you know, it's definitely not acting as well as the others. It's off the highs. But short term, you've seen some of these weaker stocks have nice little entries for trades. You know, and right here, I wouldn't say, you know, come chase us into this intermediate downtrend here. You just had a nice move off the lows, but it's acting a bit better. Overall, I know, Lindsay, we were just talking about the weekly chart. And if you look at the weekly chart, I know it doesn't give you immediate gratification, but it's still from here was the IPO low, here was your peak. And then since this low back here in 2008, it's been, you know, you have a low, higher low, trending higher, just not moving fast and furious. So on a macro basis, if you're in there, you're just not rewarded yet, but it's still intact.
Well, we're going to take a quick commercial break, and when we come back, we're going to look at some consumer stocks.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Consumer confidence was down for the second month in a row on Friday. We're going to take a look at some consumer stocks to see how they've been reacting this year and if there are trades in there. We're going to start with Kraft. This is a stock that has cost inflation pressures, relief coming in the second half of the year, international growth, and then the breakup coming in the second half of the year of the company. Stephanie Link at Action Alerts Plus likes this one, and she's buying it on opportunities and dips.
Well, I think last week you talked about the dip that she was buying, and I was like, oh my goodness, it looks a little crazy to be doing that. And then you look at it now, and she, you know, sometimes you go in the belly of the beast and you get paid for it. So if you look at the chart here, we were talking, I believe, on this day, right into the 200 day. So if she purchased it, that's a good purchase. It bounced right off the 200 day. They held it intact. It's right back into a very, very big, noisy base. So I still think it's going to take time. But if you're a macro investor, you know, it bounced here where it had to. So you're not saying the coast is clear, but you're in a better position than you were last week. And it still looks fine as a hold, just not sexy, but you can't have everything so sexy like the next one we're going to go over within this group.
Exactly. Costco has been a great stock this year. It's up like 17% for this year, up 12% in June alone. It got upgraded on Thursday by Deutsche Bank. The analyst there is saying that sales in June are going to be better than most people expect. But is this one that can reach higher levels?
Well, this is one that technically was acting much better, and this one moves fast. And some things are for traders, some things are for investors. But as an investor, you could also be involved in some of the sex and sizzle. And if you remember, when this was about to break its downtrend, it had a tight flag. I don't know, it was like a few months ago. I was like, this one looks like it's ready to go. And why wouldn't it be? Because the conscious consumer, Costco, you buy in bulk, the whole spiel of it. You look at the chart, and this was the area we're talking about right here. Okay, this was a nice move off the lows, flagging real nicely. You had this downtrend in place, and this really was a nice entry above 89.20. And ever since then, you had to move up. It held the moving averages, and then pow, new highs. This is why you go after relative strength plays versus laggards, because as an investor, you know, right now the markets are far from their highs, and look where Costco is. It looks great. Granted, there are some others you could play off the lows, but you just have to be that much more tactical and involved to find them, because some things are just dead cat bounces and some things continue.
Coke has had a pretty good run. It's been a stronger stock this year too. It's trading at 19 times, which is below its 22 multiple historic average. And it has a great dividend yield here. There is the European exposure, which could be a concern in currency risk. But what do you see in the charts?
Charts still look good, still held higher, never got back down to the 200 day. It's still, you have your dividend, you have a lot of things going on here. Again, this isn't on the sexier side, but if you look at the chart here, it's near highs, so there's a lot to like. Here's your 200 day, didn't even get close to it. Here's your 100 day, well above it, you know, so showing you relative strength. So stocks that show relative strength, when the market gets a bit better, like we saw Friday, they are the first ones to make new highs. So at this point, if you're an investor in Coca-Cola, you're doing well. And it hasn't, I guess, had any, you know, big setbacks from its European exposure, because maybe they're getting so aggravated and upset that, you know, they're drinking a little bit more and they need some caffeine so they could take a little shorter lunches.
And stay up all night.
Right, 2-hour lunches aren't working right now in Europe.
Yeah, exactly. The next one I want to talk about is Nike. It got hit really hard after a bad earnings report Thursday night. On Friday, it was down 9.5%. It's at its lowest levels for the year. But is this one we need to wait a few more days, let it see how it settles out before we can start trading it?
That's what I like to do. After like a big disappointment, after a down move already, I like to see at least a new base so I have price points to trade from. You know, Nike gave you some faulty signals over the past 3 months or so, and if you didn't take stocks into earnings, which I don't like to do, you know, that is not your problem now. Now it's your opportunity. But overall, I do think that it's a bit broken. It's going to need time. But if you look at the chart here, you know, if you're not involved in Nike yet, it's not your problem. I talk about breakout failures and why I don't like them. Look at this one that happened right here, right? It tried to break out and failed. Not only did it failed with a gap. Okay, it failed and then it gapped down, you know, and then it came down, retested, and then look at this wide range bar. This wide range bar right here told you something. Something was going on here for this, you know, weakness to come in and engulf this entire lower support. So if you didn't get out, you know, here, or this was really your exit out if you watch things closely. So if you did, look where we are now. Let's take a longer term view here. You do have some big support. I think we were talking about this the day after. This was at 81. It could work its way down at this point. Typically what happens after a situation like this, these things need to base. People will trade it versus the low here and versus the high. And if it could consolidate here for a little while and show that people and the dip buyers are coming in, the next time my traders will look at it will probably be for a gap fill or to get in there, and that'll be around 80, 78. But if this does not fill its gap, and it goes sideways and no one comes in here for it, you're going to see lower prices. Kind of like the same thing when we start going into Lulu. You can see how, you know, that wound up working out.
Right, exactly. Under Armour and Lulu, they both got bumps on Fridays, but their charts are kind of have a bearish feel to them. So what are you looking at in these two?
Lulu has not been the leader it was the last few years. It's acting faulty. It had some faulty action over the course of the past month, even before its earnings. And if you look here on Lulu, you will see that you know, it's definitely concerning. Here again, just like Nike, you had this breakout failure, which was a bit of a sell signal. Then you had this gap down, and this was with earnings, and it never got filled. So, you know, people, you know, little tidbits, trades back and forth, but then finally it wound up having a nice break to the downside. And if you look at the bounce that it saw on Friday, you know, not much. Okay, an inside day, trap some shorts. You know, I think we said cover some. I tweeted about it saying as it fills the gap, probably a good idea to cover some considering where it came from, where it is now. So if this can't get back above 6180, you know, technically on a macro level, it could see lower prices because, again, you go to your monthly chart, look where it is versus where it was. So, you know, it might feel like it had a big correction, but overall in the scheme of things, it hasn't. And when the music changes on these high valuation go-to momentum stocks, they change. And at this particular point, I'm not saying it's game over, but, you know, seeing this $40 level is not so far-fetched.
Interesting. Let's get into some quick hits. We'll start off with JP Morgan. That stock started to react a little bit better lately once we got some more clarity on the trading losses. But yesterday on Friday, it was down in an up market.
Yeah, you never want to see something be down in an up market. And when I was on the road Friday, I was talking to my staff. I'm like, JP Morgan probably is one to sell into that news, even with Facebook because of their relative weakness. So at this point, you know, don't get too chopped up here. I think the banks right now aren't as big of a headwind, or they're not at least something that people are scrutinizing as much as they were when they were near the lows. But you don't need to pay up for them. If you go to the chart, you will see here, you have this floor. I would trade against this floor. This floor here right now is around 34.50, 34.60, and it's going to need some time. There's still some problems here. They still don't know exactly what's going on with that London Well trade. You know, first it was 2 billion, 4 billion, 6 billion, 9 billion. What's a billion between friends, I guess. But overall, I think it needs time to consolidate, and at some point, then it'll be a nice trade into this gap here. But at this particular point, it has earnings coming up, and people are a little bit worried. And after a big move from the low 30s to almost 36 or 37, I would just avoid it for now.
AIG, since we're on the financial sector, had a bounce of 4% on Friday. Stephanie actually link bought some of this just because of the good news out of there about the Maiden 3 assets that they were able to sell some CDOs related there this week. But what about the chart?
I'm just going to say, let's just take AIG out of the name, and I'll just show you the chart. So let's go to the chart. Overall, above the 200-day, above the 100-day, coming into resistance. Here's your pivot. It probably will pause right here, but if it doesn't, you know, pull back much and hangs in the upper end of this area above 31, it could push through here, and that would be impressive. That would be impressive to me.
How about gold? The intermediate downtrend has been in control of this. Is that going to be the case going forward for a while, do you think?
Well, if you remember late last week, we started talking about the two trends colliding. It happened in oil and it happened in gold. So if you come back to me, you know, we talked about who's going to win, the macro longer term trend or the intermediate downtrend. And in oil, we talked about 75, 77 is a big level, that in a normal world, you should be buying oil below 80 and you'll probably be fine. But in the crazy world that we were living, maybe it can go down to the low 60s. But overall, buying from 80 down to 60 is probably better than selling. So oil had a nice big bounce, and I think, you know, it can go up a little bit more. As far as gold's concerned, it started acting really faulty. No one really knows why they're buying it. It could be, you know, a currency reason, or it could be the printing money, whatever it is. I know I had puts going into Friday because I wasn't sure, but I felt like we were going to break that 148.5. With buying puts, your risk is your premium paid instead of going actually short the metal or short the GLD. So it wound up saving me a lot of money because I had the puts. Gold was up big. I knew what my defined risk was, and I just sold it. You know, so if you're short, it's a different story. It's undefined, and then you have to stay with it. So anyway, if you go back to GLD, you look at the chart here, you will see that this 148.5 is still holding. This is the big macro support that is still intact. Look, we're still intact. We're still going sideways. And granted, it just hasn't really been trading well, especially from the long side. But you know what? That could change. Things always change, and trends are good until they change. And here, if you look closely, you have this intermediate downtrend that I've actually tried playing a few times and I lost. Last time was right here, lost. So it's still in a noisy area, in an area where I don't think you need to rush there because it still has a lot to prove. It's away from the danger zone, so to speak, here, but it's really going to have to start getting above this 158-ish in order to get some follow through to the upside and get a new trend in place. Right now, it's still trapped in the intermediate downtrend.
Well, those are the things we're looking at today. Some of the levels on the S&P 500 that we want you to watch, some stocks, some sectors, and even the commodities that we think will be moving today. So check in at the end of the day for the daily recap with Scott and the team.